Equity has potential to generate high returns, but at the same time, volatility of equity as an asset class is much higher than any other asset class. Fixed income volatility is low, but at the same time, return potentials are also much lower as compared to other two asset classes. Gold has performed well, but at the same time, gold has negative correlation to equity. And generally, gold has performed exceedingly very well whenever markets are going through difficult phase. So whenever market environments are extremely turbulent, generally gold provide a lot of protection and provides good returns at that particular point in time. But unlike equity, wherein generally performance is much more smoother across cycles, typically gold performance is much more volatile. So that's why combination of these three asset class provides optimum allocation for an investor. If you look at on right hand side, wherein we have mentioned static allocation across these three asset classes and how the portfolio would have performed. So while equity as an asset class has delivered 13.9% return in last 25-26 years, 65% equity, 25% fixed income, and 10% gold would have yielded 13.1%, which is just about 0.8% lower than equity as an asset class. But at the same time, the portfolio volatility would have fallen significantly from 22% to about 14%. So which means that on risk-adjusted performance basis, asset allocation strategy could have delivered much better outcome. UTI multi-asset allocation is a dynamic asset allocation fund, which means that allocation is not static across these three asset classes. We use in-house proprietary financial model, which helps us identify right cycle for right asset class. And typically, asset allocation outcome is about 1 to 2% better as compared to static allocation across these three asset classes, which means that following dynamic asset allocation, returns could have been similar to equity, but at the same time, volatility would have been much lesser. So key advantage of UTI multi-asset allocation fund is it provides you access to three asset class which are negatively correlated to each other. So at the same time, rather than following a particular view of the fund house or fund manager, we have developed proprietary financial model, so which takes away human bias of investing. So in the sense, typically all of us are having greed and fear. Typically we become greedy when times are good. At the same time, we become extremely fearful during uncertain market environment. So that is taken out with the help of the model. Third, it provides tax efficient performance, because generally as an investor, if you are investing in three asset class separately, whenever you are changing allocation from one asset class to another asset class, that leads to taxation, frequent tax element, which is taken out in a tax efficient way if you invest in multi-asset allocation fund. So for example, if an investor invests in UTI multi-asset allocation fund today and remain invested for 10-year period, then in this 10-year journey, there is no direct or indirect taxation on the investor, because mutual funds are passed through vehicle. So which means that the fund will keep changing allocation across asset class, but there is no taxation impact on the investor.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.